What is insurance? Insurance is a contract between two parties, the insurer or the insurance company and the insured or the person seeking insurance, whereby the insurer agrees to hedge the risk of the insured against some specified future events or losses, in return for a regular payment from the insured as premium. Insurance policy helps in not only mitigating risks but also provides a financial cushion against adverse financial burdens suffered. Insurance policies are safeguard against the uncertainties of life. There are two parties in the contract of insurance. The first party in the contract of insurance is the insured. Insured is a person who is looking to hedge his future risk of unforeseen losses or events. There are different types and costs of insurance policies available nowadays. The choice of the policy type depends on the insured as to what type of risk he wants a cover for. The second party in the contract of insurance is the insurer. Insurer or the insurance company agrees to pay for the future financial losses of the insured against a regular payment of premium. The insurance company assumes or accepts the risk of loss and undertakes for a consideration to indemnify the insured or to pay him a certain sum on the happening of a specified contingency or event. There are majorly 6 types of insurance covers. Vehicle insurance. Any financial loss arising due to accident of the vehicle owned by the policyholder is covered under vehicle insurance policy. In some comprehensive policies, the expenses on medicines for treating injuries and any other medical expenses are also covered. Property insurance. Any financial loss to the property due to fire, theft, burglary or due to any other natural calamity like flood, earthquake, etc. are covered under property insurance policy. Health insurance. Health insurance covers various types of insurance related to health. Health insurance is insurance against loss by illness or bodily injury. It provides coverage for medicine, visits to the doctor or emergency room, hospital stays and other medical expenses. Life insurance. Life insurance is an agreement between insurer and policyholder that guarantees payment of a stated amount of money and benefit either at the end of the policy or at the death of the policyholder. Human life is subject to risks of death and disability due to natural and accidental causes. When human life is lost or a person is disabled permanently or temporarily, there is a loss of income to the household. Life insurance provides a definite amount of money to the dependents of the insured in case the insured dies during his active income earning period or becomes disabled on account of an accident causing loss in his income earnings. Travel insurance. Travel insurance is the cover against risks during domestic or international travel. A standard travel policy covers death, personal accident, medical expenses, repatriation, loss or delay of checked baggage, passport loss and third-party liability. Credit insurance. Credit insurance provides a business with protection against the failure of a customer to pay their trade credit debts. This can arise as a result of a customer becoming insolvent or because your customer fails to pay within the agreed credit period. Credit insurance can reduce the unnecessary cost of bad debt and protect the hard-earned success. Let us try and understand some common benefits of taking an insurance policy. Hedge against rising health expenses. Given the increasing incidence of lifestyle diseases and escalating medical costs, insurance provides the benefits of protection against critical diseases and hospitalization expenses. 2. Provides financial security. Life today is full of uncertainties. In this scenario, life insurance ensures that your loved ones continue to enjoy a good quality of life against any unforeseen event. 3. Encourages savings, as some amount of premium needs to be periodically paid against an insurance policy. It inculcates the habit of saving among people while planning for a better future. This leads to compulsive saving, 4. Planning for life stage needs. Planning your life goals and ambitions such as buying a new house, getting married, securing your child's future etc. become much easier with wise insurance plans and provide for timely payments at various stages of life. 5. Safe and profitable long-term investment. Since traditional policies are viewed both by the distributors as well as the customers as a long-term commitment, these policies help the policyholders meet the dual need of protection and long-term wealth creation efficiently. 6. Tax benefits. Pre-tax benefits are added advantages to the policyholders. These benefits help them to save a large portion of their tax payment. When the tax payment gets reduced, their disposable income increases. 7. Assured income through annuities. Everyone wants to have a comfortable retirement, but without adequate planning it probably won't happen. Retirement insurance ensures that you or your family members receive a regular pension amount post the retirement date. You have the flexibility to choose the retirement date and the manner in which you receive the pension. Principles of insurance are the essentials or requirements of insurance irrespective of the type of insurance concerned. There are 7 fundamental principles of insurance. Principle of utmost good faith. Principle of utmost good faith is the primary principle of insurance. According to this principle, the insurance contract must be signed by both parties, insurer and insured, in an absolute good faith or belief or trust. Both parties in the contract must disclose all material facts for the benefit of each other. False information or non-disclosure of any important fact makes the contract avoidable. Principle of indemnity. The principle of indemnity is applicable to all types of insurance policies except life insurance. Indemnity means security, protection and compensation given against damage, loss or injury. The insurer promised to help the insured in restoring the position before loss. Whenever there is a loss of property, the loss is compensated. The compensation payable and the loss suffered should be measurable in terms of money. The insured will be compensated only up to the amount of loss suffered by him. He will not earn profit from the contractor. The maximum amount of compensation will be up to the value of the policy, which is fixed at the time of contract. Principle of insurable interest. The person getting an insurance policy must have an insurable interest in the property or life insured. A person is said to have an insurable interest in the property if he is benefited by its existence and be prejudiced by its destruction. The presence of insurable interest is a legal requirement. So an insurance contract without the existence of insurable interest is not legally valid and cannot be claimed in a court. The object of this principle is to prevent insurance from becoming a gambling contract. Principle of subrogation. According to the principle of subrogation, when the insured is compensated for the losses due to damage to his insured property, then the ownership right of such property shifts to the insurer. The principle of subrogation is applicable to all insurances other than the life insurance. If the insured party gets a compensation for the loss suffered by him, he cannot claim the same amount of loss from any other party. It prevents the insured being indemnified from two sources in respect of the same loss. Principle of contribution. Sometimes a property is insured with more than one company. The insured cannot claim more than total loss from all the companies put together. He cannot claim the same loss from different companies. If one insurer pays full compensation, then that insurer can claim proportionate claim from the other insurers. A person cannot be restored to a better position than before the loss occurred. The total loss suffered by the insured will be contributed by different companies in proportion to the value of policies issued by them. Principle of proximate cause. Principle of proximate cause means when a loss is caused by more than one causes, the proximate or the nearest or the closest cause should be taken into consideration to decide the liability of the insurer. This principle is found very useful when a loss occurred due to a series of events. However, in case of life insurance, The principle of proximate cause does not apply. Whatever may be the reason of death, the insurer is liable to pay the amount of insurance. Principle of loss minimization. According to the principle of loss minimization, insured must always try his level best to minimize the loss of his insured property. In case of sudden events like fire etc., the insured must take all necessary steps to control and reduce the losses and to save what is left. This principle makes the insured more careful in respect of this insured property. Let us understand some common terms used in the context of insurance business. Insurer. The company which issues insurance policy is called insurer. Insurer is a party to an insurance arrangement who undertakes to indemnify for losses. Insurer agrees to pay compensation on the happening of uncertain and unfortunate event. Insured, the person, group or property for which an insurance policy is issued is called insured. The person who is protected against uncertain losses and who is paid a compensation by the insurance company is called insured. Insured is also known as the policyholder. Policy, it's a written document that contains the contract of insurance. It's a document given by the insurance company to the policyholder, which defines the terms and conditions of the policy taken. This is an important document that needs to be produced by the policyholder to initiate any claims. Premium. Premium is the periodic financial consideration paid by the insured to the insurance company in return for the insurer's guarantee to compensate for his losses in future. The amount of premium depends on the policy amount in the cover period. Amount of premium to be paid is generally calculated in the beginning and remains same throughout the entire policy period. Claim. A formal request by the insurer to an insurance company asking for a payment based on the terms of the insurance policy. Insurance claims are reviewed by the company for their validity and then paid out to the insured. Claim is made on the happening of the event. For example, fire, flood, theft, death, etc. Actuary. Actuary is a professional person appointed by an insurance company who deals with the financial impact of risk and uncertainty. An actuary is a highly trained statistician with expertise in evaluating various types of risks. An actuary is a specialist mathematician who calculates premiums for insurance companies. Reinsurance. When multiple insurance companies share risk by purchasing insurance policies from other insurers to limit the total loss the original insurer would experience in case of disaster. When reinsurance occurs, the premium paid by the insured is typically shared by all of the insurance companies involved. This is done to protect the company from the heavy losses in case of big tragedy. This is generally considered for high-value items, for example satellites, ships etc.